Hello again and welcome back to my channel. My name is Patrick Allen. I'm a licensed realtor with Keller Williams Southern Arizona. And in today's video, we'll be discussing real estate. Short-term rentals or medium-term rentals? Which is the better path to help you achieve financial independence? It's one of the more relevant debates on local landlord forums, and there are strong opinions on both sides. With an increase in remote workers and digital nomads raising the demand for furnished rental properties with flexible leasing terms, coupled with a major erosion in cash flow due to higher financing rates, the idea that you can double or even triple the revenue that a given investment property might bring in is an enticing prospect for the modern real estate investor, but that comes with a cost. More potential for reward must mean more risk in the market to get there. And as a small-time landlord that uses both strategies to keep my rental properties occupied, I have been made painfully aware of where those potential pitfalls lie. And so if you're considering taking on a more active role in your property management and are curious to know whether an MTR strategy or an STR is a better fit, we're going to be covering that and more in today's video. And make sure you stick around towards the end because I'm going to give a massive tax tip that could definitely help sway your decision one way or the other. Let's get into it. So we'll be spending a lot of this video comparing and contrasting the two strategies, and it's probably easiest to start by covering all the ways in which they are similar. So apart from their ability to generate more monthly revenue, short and medium-term rental properties are primarily differentiated from their longer-term counterparts in that they are generally rented fully furnished. Whether you're catering towards a traveling professional, usually moving in without their own furniture, or a vacation rental guest just coming in for a few days or a few weeks, your target demographic almost certainly is going to expect the property be fully furnished and will choose to book or not book your listing based on a long list of bonus amenities that they can enjoy during their stay. While the management of 12-month leases are reasonably passive and often outsourced to a local property manager, short and medium-term rentals are more often self-managed by the owners. Not only do shorter-term leases bring in more money each month in the form of rent payments, but standard property managers either will not take on a furnished rental unit at all, or if they will, the fee they charge will be higher to reflect the more hands-on approach involved with both short and medium-term rentals. 20 or perhaps close to 30% of the monthly rents compared with closer to maybe 10 to 12% for an unfurnished long-term lease. And so not only is there more revenue coming in for short-term or medium-term rental deals, but also more money flowing out of the business for the operating expense that we call property management. As such, a move into either STR or MTR is akin to opening a new small business providing a service to clients rather than as a passive investment not involving much of your own regular oversight. Short and medium-term rental strategies can be considered exit strategies for one another. Now, as we will see later, it's pretty easy to flip a non-producing furnished NTR into an Airbnb unit as well as vice versa. However, to reposition an unfurnished long-term rental property will usually require an additional outlay of capital for furnishings and interior design just to get the listing initially set up. Now, the key differences between MTR and STR that I really want to get across in this video mostly comes down to the idea that we are talking about two meaningfully different pools of tenants, each with their own unique needs profile. Now, while there might be a bit of overlap, ultimately, if you choose to go into the short-term market, you are starting a small business in hospitality, catering to people traveling for fun for short periods of time, whereas an MTR strategy usually involves starting a small business servicing corporate or temporary housing. So a short-term rental guest may be blown away by a stellar mountain view or a luxury pool in the backyard, while travel nurses usually just want a place that is affordable, close to their work, and reasonably safe. And when locals have family relocating into town or just needing a place to stay for a while their primary home is being repaired or updated, the end user may only care that your listing is acceptably close to their current home and large enough to house everybody without paying much attention at all to your amenities package. And so depending on which strategy you want to focus on, you will need to give some thought into how far you're going to go with updating an interior design of the property prior to starting to rent it out. Let's talk a bit about the risk versus rewards dynamic of each. Now, the way to conceptualize STR versus MTR is on a spectrum of risky versus safe and stable. LTR, or long-term rental properties, being the most stable and least profitable, short-term rentals being the least stable but offering the most potential profit, and with medium-term falling somewhere in the middle, offering a bit more reward but not quite as much as an STR would. Now, I'm being mindful in this video to call it short-term rental or STR rather than using the generic Airbnb name to describe the strategy. But the sheer ubiquity that Airbnb has on the STR market brings up another issue. With Airbnb, VRBO, Booking.com, and the other OTA sites, you have access to an incredibly vast pool of tenants. However, when you choose to work with one or all of these companies, you are ultimately working with one boss, the online travel agency or OTA site itself. So while Airbnb might produce the highest possible revenue on paper, Airbnb also comes with a full slew of terms and conditions you must agree to when setting your listing up. And if you fall ill of their host policies, or even just that Airbnb decides to change its algorithm and business model at some point in the future, there's a much higher capacity for your flow of guest leads to be throttled back or completely cut off due to forces outside of your direct control. And when going the STR route, your clients will have to pay higher fees to the OTA sites in exchange to both the marketing engine, pushing the Airbnb branding to a worldwide audience of potential guests, as well as for the convenience of having them handle the back end of guest screening, payment collection, and even providing a support hotline to help hosts deal with emergency situations that infrequently occur, like major property damage or a guest refusing to check out at the end of their stay and attempting to squat inside of the property. Meanwhile, a medium-term rental play is a bit more entrepreneurial. Landlords pay a flat yearly fee to post in the marketplace on furnishfinder.com, and it is up to each owner to furnish their own lease, set up monthly rent collection, and otherwise handle the back end of everything. Now, occupancy for an MTR for a 12-month period might be similar to that of an STR approach, but they differ from each other in when that vacancy tends to occur. Because travel nurses stay for a relatively long period of 1 to 3 months or more, versus short-term rental guests usually staying 2 to 5 days at a time. However, when that same travel nurse ends his or her contract and vacates the property, it is more common to have that home sit vacant for a month or more while you work to secure your next tenant. Airbnb bookings will generally come in hot and fast, and especially the case if your listing is newer on the platform. And so the likelihood that you will make $0 in income for an entire month at a time is much less. And so now that you're probably leaning one way or the other for your next property, it is important to remember that depending on which strategy you go with, your keys to a successful operation of the asset will come down to different core competencies. For STR, I would say that the number one most important item for succeeding on the OTA sites is to keep your occupancy under control. As you may have noticed when analyzing a short-term rental deal, you will often be given a figure for total yearly revenue as well as two inputs: your ADR, or average daily rate, as well as your occupancy, which is how many days out of a 365-day year was your property actually rented out and making money for you last year. In my experience, the second number is far and away the more important number in driving your revenue projections. Whether you are an excellent operator at 90% occupied throughout the year, hitting what seems like to be the market average of, let's call it 65%, or falling well short of that figure will have a massive impact on your yearly revenue figure. Medium-term rental properties, I would say that the most important item is that of tenant screening and money collection. Because many of your guests might make a decision to rent your property sight unseen, and because you are furnishing your own lease and doing your own tenant screening, it is completely on you to make sure that your processes are effective and that you do not allow someone into your home that is likely to cause you problems. With the OTAs, you have something of a partner to help you navigate any potential tenant screening issues that might come up. But because Furnish Finder is a little bit more of a hands-off approach, you are taking on more of that responsibility yourself. Right, having covered all of that takes us back to the initial question. Between STR and MTR, which strategy is best for someone seeking financial independence? Well, the only answer to that type of question has to be it depends. And to help you sort it out for yourself, there are a few key questions you can ask yourself before you start. Now, I would advise anyone asking themselves this type of question to try to imagine your goal portfolio in 5 to 10 years. After you've achieved great success by your own definition, acquired multiple properties, and have enough income coming in to achieve your immediate financial goals, what does that portfolio look like for you? Now, if you like the idea of generating higher levels of revenue, working 10 to 15 hours a month, and actively operating a growing business, then acquiring properties for short-term rental and building up those relevant business systems will be the faster approach to get you there. Whereas if you value receiving a reasonable cash flow from your rentals off of a minimal time investment of 3 to 5 hours per month, then a medium-term rental approach is more likely to provide you with that lower stress lifestyle. Another key question to ask your future self is whether you or your spouse has the goal to achieve FIRE, financially independent, and retire early from your day job. If so, not only is a portfolio of short-term rental properties going to produce more top-line revenue, naturally making it easier to justify one member of a married couple to quit their job and live off of property management income, but the additional time and availability that is required to operate a short-term rental property effectively makes it easier to qualify as a real estate professional, an amazing tax benefit to those who spend their full-time hours working in a real estate related field like broker sales, property management, or construction. However, if you are not in a position where you can be immediately responsive to guest inquiries or would simply prefer not to be immediately available, then a medium-term rental approach will likely provide you with a higher dollar per hour pay scale. It also comes down to the property itself. More specifically, what amenities does the property offer that might be competitive for the furnished rental market? When we are looking for a new property to buy and turn into a rental, we can consider the end goal in mind when deciding whether to submit an offer on a given listing. But if we're instead looking at a deal that you already own and are trying to repurpose it into either a short-term rental or medium-term rental, we must start with a basic viability analysis to see if the property can truly meet the demands of either demographic. Now, because MTR guests are often budget conscious and more frequently travel by themselves, there seems to be a more consistent demand for smaller homes with fewer amenities and lower pricing. After all, why work so hard to earn a good income just to turn around and pay it all back to the landlord in the form of rent? But with short-term rental, it's often the opposite. Not only are their stays not as long, but because they are traveling for pleasure and enjoyment rather than business travel, they are much more willing to spend $100 to $200 or more per night for days and weeks on end if your property's amenities and appeal is justified. And so if the property that you were analyzing is a particularly large home with 3 or more bedrooms and set up as a luxury stay with many amenities, there will be a bigger demand for that on the OTA platforms. Whereas 1-bedroom and studio apartments are exactly what many traveling professionals are looking for, and those folks may not even think to look on the OTA sites to find that type of residence. And it's just as simple as that. Both short-term rental and medium-term rental strategies can be effective ways of boosting your cash flow and increasing the overall profitability of your asset, provided you are ready to risk both your time and the additional capital you will need to invest to fully furnish and decorate your unit to create a marketable theme that will draw people in more so than your competition. I hope this video helped you weigh the pros and cons, and whichever strategy you decide to start with, know that you are entering a community with hundreds of thousands of members who have already done that thing that you were so afraid of messing up. Join a local meetup, check into the huge web of investor resources offered by biggerpockets.com, and if you have a moment, leave me a comment below to let me know which strategy you ended up going with and what your experiences has been like so far using that strategy. Either way, in this brave new world of lower affordability, rapid inflation, and a real estate market making it harder and harder to find great deals, let's all celebrate the fact that we at least have several ways to reposition our properties into more or less efficient drivers towards our long-term financial goals. So that's all I got for today's video. We'll see y'all in the next one.